If I had $1 million saved up and wanted to retire at 62, I wouldn't start by asking whether that's enough money because that's actually where people can go wrong. The real question is, how can I use that $1 million to make retirement work for me? Because two people can retire at 62 with the exact same amount of money, spend the exact same amount, have the exact same market returns, and still wind up with two entirely different outcomes. One of them feels in control. The other runs into tax problems, withdrawal mistakes, and a lot more stress than they expected. That's why in this video, I'm going to walk through exactly what I do if I had $1 million saved up and wanted to retire at 62. So you can see what I'd prioritize first, what actually matters, and where people tend to make the most expensive mistakes. And if you want help mapping this out together, remember there's a link in the description. You can click the link, book a call, and I'm happy to walk through your numbers together. So if I had $1 million saved and I wanted to retire at 62, the first thing I do is decide how I want to control my income in those first few years. Because retiring at 62 as opposed to a little bit later is quite a bit different. Number one, your savings need to last longer. Your decision of when to and how to file for Social Security becomes a little bit more important. And your healthcare planning is substantially different. Most of us are going to obtain healthcare from Medicare when we're 65. If you retire before then, your options might be limited. You might need to seek healthcare through a state marketplace exchange or somewhere else. And if you're someone who's going to obtain your healthcare from a marketplace exchange and Affordable Care Act, Obamacare policy through your state's marketplace, you might know that the premiums you pay depend on your income. Those plans are subsidized by the federal government. And if you make more than a certain amount, you're going to pay the entire cost of that healthcare policy. But if you're under those thresholds, you're going to pay less thanks to this government subsidy. So the form and the character of how you're producing your income in these first few years matters because it will determine how much you pay for your healthcare policy before you enroll in Medicare. So what I would think about first is how do I design an income plan that maximizes these healthcare subsidies over the period before I enroll in Medicare, between 62 and 65. Now, I say subsidies because these plans are subsidized by the federal government. They show up to us as taxpayers in the form of a premium tax credit. The way this works, and a lot of people make a mistake here and wind up with a big unexpected tax bill, unfortunately. The way it works is when you go to enroll in one of these plans through your state marketplace, you go to their website, they ask you some questions. One of those questions is how much income are you going to make this year? And then they take you to a screen where they show you all the plans that are available in your area, and they give you a number of what it's going to cost you every single month. That number might include that premium tax credit. And they come up with it based on the income that you input on the previous screen that you think you're going to make for the year. So let's say that you don't think you're going to have very much income. You put a relatively low number in the onboarding form. They show you a premium that includes a substantial premium tax credit from that government subsidy. So maybe you only have to pay a couple $100 a month to obtain this healthcare plan that you're looking at. So you get the plan, you pay a couple $100 a month, then at the end of the year, you go to file your tax return. Well, if you made a mistake in your income projection, maybe you had more income coming in than you expected, well, that's all going to come out in the wash when you file your tax return. And it might be the case if your income is higher than what you put on the form that you're not actually eligible for that premium tax credit or perhaps as much of it as you thought, and you have to pay back all of it from what you should have been paying throughout the year in the form of premiums directly to the insurance company. So this trips a lot of people up because if you just get the income projection wrong, or maybe you put an artificially low number in there because you think you're going to have to pay less out of pocket, well, it all comes out in the wash when you file your taxes for that year, and it might mean that you wind up with a big unexpected bill. So let's go through an example. Let's say we have two people that are both about to retire. They're both 62 years old. They both have $1 million saved. Let's call them Roy and Linda. They have $1 million saved between $500,000 in IRAs, $100,000 in Roth IRAs, and $400,000 in taxable brokerage accounts. So Roy and Linda both need to spend $6,250 per month to live. Let's say that they're both entitled to Social Security benefits with a primary insurance amount of $3,500 a month. Remember, your primary insurance amount is what your Social Security benefit will be if you file exactly at full retirement age. age. Let's also assume that Roy and Linda both live in California, where I live, and if they enroll in an ACA marketplace healthcare plan, that they'll have to pay $800 per month if they don't qualify for any of these subsidies premium tax credits. Now, the rules for the Affordable Care Act, when the Affordable Care Act was put into law here a few years ago, it set these subsidies and the premium tax credits up based on the federal poverty line. If your income for the year, or more specifically, your modified adjusted gross income, exceeds 400% of the federal poverty line, you do not qualify for any premium tax credits. You have to pay the full cost of that marketplace health plan, which in this case is $800 per month. If your modified adjusted gross income is less than 400% of the poverty line, you qualify for some form of these subsidies. Now, that poverty line, 400% of it is $62,600 this year. So for Roy, let's say that Roy is worried about taking too much money out of his accounts at the beginning of his retirement. So he decides that he wants to file for Social Security right when he retires at age 62. If Roy does that, he's locking in a Social Security benefit of exactly 70% of his primary insurance amount. So he'll be entitled to $2,450 per month in Social Security benefits. This means that he needs to pull $3,800 a month from his investment portfolio in order to live and make up his retirement income gap. Now, on top of this, Roy is really concerned about mandatory distributions down the road and the tax problems that might cause. So he decides that he wants to take the entirety of that $3,800 a month out of his IRA because he wants to shrink his pool of assets that are subject to those mandatory distributions in the future. This means that every penny coming out of his accounts is going to be added to taxable income. And when we do a tax projection on that income and the Social Security benefits, his modified adjusted gross income this year is going to be $70,590, which puts him above 400% of the federal poverty line, $62,600. So since he's above the 400% of the federal poverty line, he's going to have to pay the entirety of that $800 a month for the healthcare plan. Now, in Linda's case, let's assume that she wants to suppress her income as much as she possibly can over these first few years, at least until she turns 65, in order to capture more of the premium tax credits. So she's going to wait to file for Social Security until she's at least 65, maybe 67 or some older age than that. We're not really sure quite yet. And instead of taking money out of her IRA to meet her living expense needs of $6,250 a month, she's going to take money out of her taxable accounts instead. So $6,250 a month works out to $75,000 a year. And in those taxable accounts that Roy and Linda have, let's assume that they have a balance of $400,000, $250,000 of that is basis. So what this means is that about $150,000 of the account values are unrealized capital gains, or about 37.5% of the accounts. That means that for every dollar that Roy or Linda wants to take out of those accounts, they're triggering a long-term capital gain of 37.5 cents. So in Linda's case, she's going to take money out of that account first. She takes $75,000 a year in distributions. That means that she's triggering $28,125 in long-term capital gains. So that's precisely what Linda's modified adjusted gross income is going to work out to be, $28,125. This puts her in the 0% long-term capital gains bracket. So not only does she have to pay 0%, she's not paying anything in federal taxes by harvesting those gains, but her income is going to be 189% of the federal poverty line, which means that on that $800 per month healthcare policy that she and Roy are both going to get, Roy's paying a full $800 per month for it. Linda's only going to need to pay $140 per month for the exact same policy because she kept her income lower and will capture more of these premium tax credits. So you can see the mistake here. This is precisely where most people I've spoken with who plan to retire in their early 60s tend to go wrong. They start with the Social Security decision and then they back into the income plan and whether they have enough money in the accounts to support all these decisions, but they totally neglect the ACA premium tax credits. And that's a big mistake because it can move the needle over these first few years because of how much you might have to pay for the healthcare policy. The next thing I would do if I were 62 and trying to retire with $1 million million would be to determine when and how I'm going to take money out of my accounts. Generally, the way that I like to do this is with a lifetime tax projection. So we have to make some pretty liberal assumptions when we do something like this. If we look at a 30, 35, 40-year period of retirement, well, realistically, we really have no idea what the tax code will be even 10 years from now. That being said, what I would want to know is how much tax am I going to need to pay based on various distribution patterns and when, given the current rule set. So if I decided to take money out of my taxable accounts first, like Linda, and then go to maybe my IRA and then my Roth, what does that look like, all things considered? But if instead I wanted to be like Roy and take money out of my IRA first, well, that's going to have a different impact on long-term taxation and a different impact on those ACA premium tax credits we were just talking about. What I would want to know is, what does that look like in the aggregate? And when I see people do this for themselves, quite often they are completely neglecting and omitting those premium tax credits based on what their personal healthcare plan is. The reason I would go here next is that the source of your income has a more dramatic long-term impact than most people think. Obviously, if you take money out of the IRA instead of the Roth IRA, well, you're going to have to pay tax on that distribution. That impacts things now. But what a lot of people don't fully appreciate is, even though you might be paying more in tax today, that's also shrinking the pool of assets that will be subject to mandatory distributions down the road. If you're trying to retire at 62 with $1 million, you might be in the position, if you juggle your distribution patterns properly, that you could get your mandatory distributions out of the IRA in the future to match what you think your spending needs are going to be. And that could be pretty convenient when you think about this in the aggregate. Now, in practice, when we do this in our financial planning office, we often like to start with these exact factors. We do a long-term tax projection. We try to understand what our clients are really trying to accomplish. Is it maximum spending at the beginning or at the end of retirement? Is it leaving a bequest to a family member or to an organization? Is it to pay the absolute minimum amount in taxes? Is it to bounce the very last check that they write to get the most out of the resources? Everybody looks at this differently. But generally, we like to start with the distribution and the tax strategy first, and then we kind of overlay the Social Security filing decisions, a strategy on top of that. When we get to that point, we need to make sure that we've got reasonable assurance that whatever strategy, whatever path we're taking is not going to result in us spending through the entirety of our nest egg and running out of money in our mid-80s. And that's where we incorporate what's called a Monte Carlo projection, just to make sure that we're on track generally. Now, Monte Carlo analysis, you may have heard of it before. I hate that they use the term Monte Carlo for this type of analysis because it implies gambling, when I don't like to think of financial planning as gambling, because it most certainly is not. But basically, when you run one of these kinds of analyses, you have a big database of market history. You know the likelihood that any given asset class you might invest in goes up or down or sideways, and the magnitude of what those changes have looked like across history. And then you also know how all these different asset classes tend to behave against each other through what are called correlations and covariances, basically using the benefits of diversification to your advantage. And then we plug a client's situation into the software. How much do we want to spend? What are we invested in? What's the tax situation? What's the Social Security situation? What about this insurance and that and the other? And then we instruct the program to run 1,000 different trials, knowing the probabilities that all of these investments might go up or down. And the output is, at the end of our retirement period, we can use, again, 30, 35, 40 years, whatever we want. In how many of those 1,000 trials did we get to the end of the period with some money in the bank, and in how many of them did we work the account balances down to zero? So this is a pretty helpful barometer for whether we're on the right track. I've seen a lot of these pieces of software that provide Monte Carlo analyses. They can be kind of dangerous if you don't know the assumptions going into them. And I do need to say that we're making a whole ton of assumptions when we run one of these kinds of analyses. All we're doing is using market history and assuming that those patterns are going to remain consistent in the future. And there's absolutely no guarantee of that. We don't know what the world's going to look like in 5 years or 10. We don't know what the tax codes are going to be. We're making pretty broad assumptions here that what we're putting into these programs is going to remain consistent in the future. That being said, it is a very helpful barometer just to generally gauge whether we're on the right track or whether we need to adjust some of the other planning inputs, some of the timing decisions, adjust some other components of the plan to give ourselves a reasonable chance of long-term success. So as you can see, two people with the exact same savings, the exact same Social Security, the exact same spending needs can have two very different outcomes depending on where they're taking money from first. And if we look at this Monte Carlo analysis for Roy, he wants to file for Social Security at 62. He wants to take money out of his IRA first. His chance of success based on this Monte Carlo analysis is 52%. So if we run 1,000 trials, in 520 of them, did Roy get to the end of his retirement timeline with money in the bank, and in 480 of them, he worked his account balances down to zero at some point. In Linda's case, she's going to wait until 67 to file for Social Security. She's going to take money out of her taxable accounts first, and her chance of success based on this analysis is 69% just right out of the gate. So most often when people come into our financial planning office and want to talk about their retirement income planning, they're starting by defaulting to some benchmark rule of thumb, like the 4% distribution rule. And they just jump to the conclusion that if they're taking less than 4% out of their accounts in the first couple of years, that they're in good shape. As we can see with Roy and Linda, there's a lot more to it than that. There's the concept of where the money is coming out of. There's the concept of the tax situation that puts us in, whether or not we're capturing these premium tax credits. If you're retiring before the age of 65, there's a Social Security timing. There's a whole lot more to it than just that generalized rule of thumb. The very next thing I do is figure out how to use this early retirement window to my advantage. This is kind of a unique period in our circumstance here between 62 and 65 years of age, because you have a lot of choices still. You have a choice of when you want to turn that Social Security income stream on. You've hit peak retirement portfolio. You probably have a choice of which account you want to take money out of first, and you don't have mandatory distributions to worry about quite yet. Everyone should take advantage of this window, and that doesn't necessarily mean Roth conversion. You might want to take money out of your Roth accounts to pay your living expenses first and then just deal with those mandatory distributions in your 70s and 80s and beyond. The point is, this is the window where you can still make those choices. During this time period, you should be weighing different options. What's my income strategy going to be on day one, and how does that impact the picture 20 years from now? Are Roth conversions or those other strategies the right fit for me? Am I comfortable with the trade-offs of my retirement income plan? The point is that this is the period where you still have options, you can still make adjustments and choices. So let's go back to Roy and Linda. Remember, Roy didn't weigh his options. He was really scared about the impact of mandatory distributions. He was convinced that he might get shot into a higher tax bracket and wind up with some big nebulous tax bomb in the future. And so he jumped to the conclusion that he needed to file for Social Security right at age 62 and take everything else he needed in terms of spending money out of his IRA instead of anything else. Well, we ran the Monte Carlo projection in that scenario, and he wound up with a 52% chance of long-term success based on that method of analysis. Well, Linda, on the other hand, she evaluated her different options, and she decided to wait to file for Social Security and take the money out of her taxable brokerage account first in order to keep her tax bracket low between 62 and 65, capitalize on these ACA premium tax credits, and otherwise put herself in a better long-term position for success. Her Monte Carlo result was 69%. And after some further consideration, Linda realized that if she postponed Social Security a little bit longer than that and waited until 70, she could boost that Monte Carlo analysis result all the way up to 75% and give herself a really good shot at long-term success. So you can see the difference in approaches here. Roy got scared because of the tax impact of mandatory distributions, which he didn't quite fully appreciate or understand. He didn't weigh all the options, he just jumped to the conclusion that seemed to assuage his long-term fears. Whereas Linda took a more rational and objective approach. She looked at all the options, turned over every stone without jumping to the conclusion of which path she wanted to go down. And by doing so, she's putting herself on a much better, stronger long-term path. This is where we see a lot of people go wrong with their own retirement and financial planning, is they see some big flashy headline about a new tax strategy or investment opportunity, and they get excited and they jump right into it without modeling anything out first. When we're building our retirement plans, we need to make decisions based on data, logic, and rationality. And that's just inherently hard for us to do as human beings. Then after that, I'd figure out how to fit Social Security into the plan. If you've watched the video to this point, you've probably already figured out that this decision needs to be fit into the rest of the comprehensive plan as opposed to an isolated decision all of its own. Now, my preference here, if I were retiring at 62 with a $1 million portfolio, would be to try to maximize these ACA premium tax credits, a lot like what Linda in her hypothetical example decided to do. And that implies waiting to file for Social Security until a little bit later. In Linda's case, she saw the later that she waited to file for Social Security, the higher her chances of success in her own Monte Carlo projection. She went from filing at age 67, her full retirement age, with the Monte Carlo chance of success at 69%, seeing that result go all the way up to 75% if she waited until 70. So my personal preference would probably be to do what Linda did and plan on waiting all the way until 70. The other side of this is, again, thinking 20, 25 years ahead. I think that guaranteed income becomes a little bit more important the older we get because our comfort level with risk tends to go down with age. And so if we're making a decision between filing earlier and collecting more checks but at lower amounts or waiting a couple years, in my mind, if I'm going to live into my late 80s or 90s, then I'd much rather have a little bit more guaranteed income in my later years in exchange for giving up those 3 years of checks between 67 and 70. This is another area where we see people make mistakes pretty frequently, and that's underestimating the importance of that guaranteed income as they get older, as our comfort level with risk goes down. Anecdotally, when we talk with people who've already made their Social Security claiming decisions after the fact and they're reflecting on it, it's usually the people that decided to file before their full retirement age that regret the decision. The people who file at or after full retirement age, all the way up until 70, are the ones that tend to be more comfortable with their decision after the fact. So again, this is where costly mistakes are made. Not because $1 million is automatically not enough to retire on, but because a lot of folks out there are making decisions about their retirement and financial plans without looking at the full picture. So if you have questions about your plan, there's a link in the description. Feel free to book a call. We can go over your numbers together. For me, the next step would be to look ahead into the future at the sources of income coming in at that time that I won't be able to control. More specifically, that's Social Security and my tax-deferred retirement savings, retirement income, whatever you want to call it. When you make your decision of when to file for Social Security, unless you decide to reverse course and walk it back within 12 months of your filing decision, that decision is going to be permanent for the rest of your life. And as we know, all the money you have saved in the IRAs, the 401ks, the tax-deferred accounts, it's all going to need to come out of the accounts when you're older, thanks to the mandatory distribution rules that currently begin when you turn 75. And so we see again that this period in your early 60s, when you have choices, you have flexibility, is a really important window to figure out the best path forward that's going to suit you and your needs for the rest of your life. Years ago in our financial planning practice, we had somebody who came in, they were 73 years old. They had just turned 73. And I should back up. Right now, mandatory distributions begin in the year that you turn 75. That didn't used to be the starting age. It used to be a little bit younger, 70 and a half for quite a while. This person had a bunch of money saved in their IRAs, but they just hadn't done the planning work to know that they were subject to these mandatory distributions and they'd actually missed a couple years of them. They should have taken money out of their tax-deferred accounts. They didn't know about the rules, so they didn't do it. They had to pay a penalty and taxes and all that. But more so than that, they didn't have any flexibility to build a retirement plan that suited their needs because they hadn't done that planning before they hit mandatory distribution age. Now they were a couple years into their mandatory distributions and they simply didn't have any flexibility. There were things they could have done to improve their financial situation, to reduce their lifetime tax liability, to potentially leave more to their family when they expire years down the road. Those options were simply taken off the table because they didn't get to them in time. The last thing I'd do if I were trying to retire at 62 with $1 million would be to take a step back and evaluate how much long-term flexibility this specific plan actually gives me. And the reason that I would do that and why I think this is important is because nobody has a crystal ball or has any idea what the world is going to look like a few years from now, or what the markets are going to look like, or what the tax code's going to do, or whether we're going to be at war or not. Anybody who tells you that they know those things with specificity either doesn't know any better or they're lying to you. The one thing that I can guarantee is going to happen is that the world around us is going to evolve over the course of your retirement. Again, we don't know why or how, but it is going to change. Our lives evolve. That's why it's important to evaluate how much flexibility your plan actually provides. And that's a component that may or may not be important to you based on your circumstances. So the point is that change is imminent, and the plans that we see that tend to work for people are the ones that can flex and adjust. You might decide that you want to change up your distribution plan or strategy a couple years into that because of your life circumstances. And the more flexibility your plan can provide, the more power that you retain 10, 20 years down the road. And just like we saw with this gentleman that came in at 73, after his flexibility period was already behind him, most often when people come to our office with issues, it's because they didn't build enough flexibility into their plan, or they didn't have one at all in the first place. So to be specific, this flexibility that I'm talking about usually comes in the form of mandatory distributions. The math on how these mandatory distributions work is that you take the account balance of your deferred account at the end of the previous year, you divide it by this life expectancy number that the IRS gives you. It begins at 75. At 75, you're required to take out more or less 4% of the account balance. Every year you get older, your life expectancy goes down by about 1. So the smaller the denominator, the more you have to take out of the accounts. So the more heavily that your plan relies on those mandatory distributions for the income, the less flexibility you tend to have. This might be totally okay for you. Back to Roy and Linda, Roy made a plan because he was concerned about the impact of mandatory distributions in the future. He's actually going to wind up with more flexibility in his plan because he's taking money out of that IRA first, shrinking that pool, and he's preserving the Roth and the taxable accounts for later. But the trade-off is that he has a much lower chance of success long-term. He's at 52%, if you remember, compared to Linda's 69 or 75, depending on when she files for Social Security. Linda has a much higher chance of long-term success based on that Monte Carlo, but the trade-off is she will have less flexibility. If I were making this decision, if I were retiring at 62 with $1 million, I think I would err on the side of Linda's path. Yes, you have less flexibility down the road, but I'd still rather make an extra buck and pay tax on it than not make that extra dollar in the first place. And to me, that higher Monte Carlo chance of success outweighs the flexibility that I'd be giving up. So to be totally clear, this definitely does not mean that retiring at 62 with $1 million is always going to work. The devil's in the details. It depends on what kinds of accounts you have the money in, what your Social Security looks like, what your unique tax and estate considerations are. The point here is that the answer is not hidden in some magic number, it's in the plan. The same $1 million can create a very different retirement depending on how intentionally it's used. Retirement with $1 million isn't just about the size of the portfolio, it's about how well the plan is built around it. So again, the point here isn't to say whether $1 million is enough, it's to say that everything depends on how you structure retirement once the paycheck stops. One of the biggest decisions here that can make or break a financial plan is when you file for Social Security, which obviously we talked about in this video. For a lot of people out there, and they file for Social Security too early, they lock in a lower rate, a lower amount of benefits, and they don't realize that they've made a mistake until it's too late. So if you want to understand how to think about that for your situation, make sure you watch this next video on this exact topic. I'll cue it up right now.